The recent increase in the U.S. unemployment rate has set off alarms, as it has triggered the SOM rule, a historically reliable recession indicator. But what does this mean for the economy? And should we be preparing for an imminent downturn? The SOM rule, named after economist Claudia Sahm, is designed to signal the onset of a recession when the 3-month moving average of the unemployment rate rises by 0.5 percentage points or more above its lowest point in the previous year. This rule has been remarkably accurate, correctly predicting every U.S. recession since the early 1970s. As of the latest jobs report, the U.S. unemployment rate rose unexpectedly from 4.1% to 4.3%, surpassing the threshold that triggers the SOM rule. The current reading is 0.53% above its 12-month low, setting off this important economic signal. Historically, this would be a clear warning sign that a recession is either underway or imminent. Out of the 11 times the SOM rule has flashed since 1953, the economy has been in a recession in 10 of those instances, with the only exception being in 1959, when a recession followed just 5 months later. So, is a recession inevitable? According to Claudia Sahm herself, this time might be different. Sahm has pointed out that the recent increase in the unemployment rate could be misleading due to the unique economic conditions we're experiencing. She notes that much of the rise in unemployment can be attributed to a significant influx of workers into the labor force, particularly from increased immigration. This surge in labor supply, rather than a weakening economy, could be inflating the unemployment numbers, making the SOM rule less reliable in this context. Despite these reassurances, the markets have reacted strongly to the news. Major indices like the Dow Jones Industrial Average, the S&P 500, and the Nasdaq Composite all saw significant drops following the release of the jobs report, reflecting investor anxiety about a potential recession. Specifically, the S&P 500 fell 3% in its biggest one-day drop since September 2022, while the Nasdaq 100 dropped 3%, erasing a staggering $907 billion in market value. The impact of these economic signals isn't just limited to the US and Japan. The Nikkei 225, the country's primary stock market index, is experiencing its largest two-day drop in history, surpassing even the infamous 1987 Black Monday crash.